All right. Hey, everyone. Douglas here. Welcome back to the MMT Macro Trader live stream. As you can see, I'm flying solo tonight. Bijou is getting a well-deserved evening off, morning, really early morning for him. But we're back at it for another exciting week of the MMT Macro Trader live stream. Everyone, welcome. Danger Zone first in the chat. Thanks for dropping by. 100 MMT Macro Trader chat points to you for being number one. Everyone else, welcome. We have a lot to cover tonight. A lot of fun stuff to go over. The Bob Murphy Show finally launched last week, and I had my interview with, or kind of podcast with him, so we'll go over that tonight. Also, over the last few days, I have been building a super secret model, something that has been ruminating in the back of my mind, really an update, a refresh to a model that I built in the past, and I'm going to share it. We're gonna go over it. I think it is. I'll give you the context to it a little bit more when we get there. I think it's pretty darn awesome. It allowed me to use a new tool that I've never used before, XGBoost, which is a machine learning algorithm. And I think it's kind of tailor-made for what it is that I wanted this model to be. So look, if you're into markets, if that's your thing, this is your live stream tonight. We'll go over the podcast, and then we'll kind of talk markets for a while in the second half. Since I am in complete control of tonight's live stream, we're going to go wherever it is I want to go. If you are joining, make sure you say hi in the chat, drop a line, let me know that you're here, hit that like button, smash it. I mean, don't, nicely push the like button. Yeah, we're going to get into things. We'll talk Bob Murphy Show out of the gate. If you have any thoughts, let me know. WWE fan Josh, welcome, man. Take a bow, sir. You killed it on the Bob Murphy podcast. Just watch it. Thanks, man. I appreciate that. Let's go ahead and highlight that. We're going to see how well I can do on a solo stream tonight while I get distracted by all the things that I got to run. But hopefully we can do a nice job tonight. Yeah, thanks, man. I appreciate it. So far I've looked at the comments and they all seem positive. I mean, obviously the anti-MMTers are not gonna applaud me for my efforts, but so far at least those in my camp think I've done a fair job. I actually had Warren Mosler reach out to me, and we're gonna have to get him on in the coming weeks, and he had some feedback for me, so I thought maybe we'll have him on, and he can roast me and tell me where I need to make some changes. Let's see. Danger Zone. Do I ever use the MACD? No, I don't. I mean, I use I use various kind of momentum style indicators. I kind of made my own proprietary one, I think, in the grand scheme of things, though. You just pick your favorite momentum indicator and you just run with it, and I think they're helpful to to a certain extent. So no MACD, but I do use a momentum indicator, and it's more or less. I don't have any momentum indicators directly tied into any of my deep learning models. In theory, the deep learning models should actually understand that and the way they get created. So no MACD. Let's see. The real progressive stream stopped, and the MMT Macro Trader stream begins. Nice. Welcome, Thomas. Appreciate you joining. So, all right, we're starting to see the viewers kind of roll on in. So again, hit that like button as we get things underway. The plan was to have Bijou kind of grill me and tell me everything I did wrong during the stream. So I'm going to have to during the podcast with the Bob Murphy Show. But again, if you haven't seen it yet, I did. It is up on the YouTube, or on Bob's YouTube channel. Roger, welcome, man. Thanks for dropping by. Eugenio, also welcome. Welcome. So it is there, and you can see the charts there. I mean, obviously you couldn't see them in the audio, and apparently they were coming in a little fuzzy. So I don't know if that's I don't know if that's just the way that YouTube compressed the video or what. But from what I could tell when I was sharing them, they looked okay. Let's see. I'm sorry, guys. This is I usually have Bijou to cut in when he's always done a good job of knowing when I need him to kind of cut in, and I'm getting distracted by a comment. I know you said after you did the podcast that you don't know if Bob was coming around, but to me, he started to get it a little. Yeah, actually, I've seen him make some comments that clearly I think he gets the MMT side. And in fact, you know what? That is something I don't have it brought up, but I will. I meant to do this tonight. We can talk about this, but he had a back and forth with Ron Gray, and I thought it was a good. I actually thought the point he was trying to make was at least a valid point, and I kind of want to talk a little bit about that tonight as well. Whether or not it was a good point remains to be seen, but it was at least a bit of a valid point. So yeah, we can kind of go down that path. I think he gets the gist of what MMT is trying to say. In fact, one of the things I was doing this week as well is I actually went back and listened to a presentation he gave a little bit of around a year ago to a group of, I think, kind of like-minded people. And if there's anything that I wish I could shake him and kind of the Austrian school from, it's this idea that like the 0% interest rate is somehow unnatural, right? That like that the Fed funds rate and then ultimately the yield curve there on out would be anything but zero if the Fed didn't intervene, right? I mean, I think that's a great point that MMT drives home, that Moore and Mosler has driven home over the years, is the natural rate of interest is zero, and that government intervention, government manipulation of the interest rate is anything above zero, right? That is actually big government coming into the marketplace and putting the interest rate at a position where it is unnatural. And so, I think I can flank the Austrian and say, no, I'm the real small government proponent. If you're really a small government proponent, I'm getting a disconnect from OBS. Hopefully that was only short-lived. It looks like we're back on. Sorry about that. It would have to then be set permanently by Congress. If it wasn't, then the natural rate would be zero. So if we do the end the Fed movement, the natural rate is zero, and that is what I would prescribe and where I would want it. So hopefully I can shake him from. All right, hopefully that part can hit for the Austrians, because I think once they get that, the rest of the blocks will follow. Let's see. All right. If you guys have any feedback or anything like that, let me know on the podcast. I will certainly respond. I thought what I could do this is gonna be difficult to do, but I thought I could go through the comments and kind of read them off one by one, or at least engage with some of the comments that seem to have some feedback. One that I've already ran into too. Actually, no. Let me do this. We'll put the podcast up there again. You can listen to it. There were two things that I told him I'd get back with him on that I just didn't really understand what he was getting at. The first one was this whole idea of, is there some sort of alien civilization that's in debt to us, or that we are in debt to, right? That's run a surplus so we can run, or that's run a deficit. How would this go? Run a deficit. So right now, this has been... anyway, I'll keep going. It says it's reconnecting, so I don't know what's going on. Let's see. Where was I going? I got off track. Now I've forgotten what I've done. Yeah, I'm having connections issues as well. Danger zone. Hopefully it settles. All right, it's looking like it's settling, guys. I'm having a strong connection on my end, so I apologize for the stream issues. We should be back up and running. All right. So one of the things that he said was, is there some alien nation that is running a deficit so we can run a surplus? And I think what he's trying to get at, and I think, one of the things that maybe I'm guilty of in terms of kind of pressing the Austrian argument. Yeah, Teddy Bruschi, the Austrians are cutting my connection. One of the things, and this is probably just because I push the MMT focus so much from the financial side as opposed to kind of the real economy side. But from a sectoral balance accounting standpoint, the government spends its net private assets or net financial assets to the private sector. The private sector is going to run a deficit, or is going to run a surplus when the the government sector runs a deficit, and so there's that dynamic at place. And again, I think where the disconnect is that I don't definitely push enough on is that I'm not saying that is in any way growth, right? That's not real growth, and so the counterpoint would be. We managed to get growth without ever having a deficit. The first person to make something, right? Economic growth, the first person to make something. And I don't disagree with what they're saying from the framework that they have it. I guess what I, then try and contend is that in a monetary system, right, where we are not in a barter system any longer, but we're in a monetary IOU system, we account for that using the rules of accounting. And then when you bring in the rules of accounting, what you end up getting is, this idea that someone's got to be in surplus or someone's got to be in deficit for anyone else's surplus. And in that sense, the globe as a whole is net zero, and someone's always running a surplus, and someone can run a deficit, and that's just how monetary systems operate. The other one that he brought up was this idea that could debt to GDP go on forever, right? Could it hit an infinite ceiling? And again, I didn't have this chart pulled up in front of me, and then two, I kind of knew there was an upward trend over the years. I didn't exactly remember what it looked like in real time. And then two, it wasn't exactly connecting the dots with what his argument was, like that it need to go to infinity. And my ultimate, conclusion is it will need to go higher if, one, it would need to go higher to get one. If you're just going to get growth, it would need to go higher relative to GDP over time. If we were running essentially no private debt and we were running some sort of net import, which we are at this point, right? And so. Yeah, Ty, I'm sorry, man. Sorry about the streams, Roger Lucas. Yeah, Bijou's out tonight, so it is running solo. Sorry about the ads. I gotta try and kill them at some point. Let's see. It's saying I'm having streaming issues. Yeah, the public debt look like. Once again, I'm cutting out, guys. I am really sorry about the cutout here. It looks like it's just going to probably happen intermittently throughout the night because everything on my end is looking good in terms of the stream. Maybe I stop and start it back up again. God, I hate when this happens. I think I might do that. If we cut out one more time, I'm going to do that. Just stop and then start it up one more time, and then we can just kind of get back to where we were at. Because again, I do have some fun stuff to show tonight that I do want to drop research wise. So that was the other point that he made. Again. Could it go forever? One, the other thing too is I think in the Austrian mind, and maybe he could convince me, or maybe he would tell me this is not what he thinks. But in the Austrian mind, any government spending is always taken away from what would have been private sector spending otherwise, right? So in the way their kind of banking system works. And thereby, the money multiplier and that sort of thing. That's how they would see things play out. And so I don't think they can get GDP growth through government spending. Maybe they do, but that it's certainly from kind of an MMT perspective, it's not inherently bad. It might not be good, but it's not inherently bad for there to be GDP growth while government spending increases. So no, I don't think it has to go to infinity. I think there are times where we certainly would want it to grow higher, and then times where maybe it will stagnate over a time period. All right. Let's see. Let's do this. Let's go ahead and run through some of the comments that were left. I'm sorry, guys. I have to do one quick thing here, and let's do that. Let's run through comments on the tweet here. Let me pull that window back up, and maybe not. One second. Flying solo is more difficult than I thought it was going to be tonight. All right. We're gonna go. Let's do this. The first comment that I want to address is the point that I brought up is one of the ideas I was trying to drive home. Was the kind of the debate, if you will, that we were having was this idea of the yield curve inversion causing a recession, right? That there's some causal mechanism there, and the Austrian business cycle effectively says the 0% interest rate, distorts market signals, and then you get some artificial boom because of the 0% interest rate, and my contention is the Fed sets the interest rate based on what they are seeing the markets doing, right? And that anything obviously above zero is an unnatural rate at that point. So that was kind of my argument that I was trying to make, and that really what you end up seeing is the interest rate drop because the Fed is seeing the signal from the business cycle that we're starting to see things cool down, so to speak, which is just a natural cycle that takes place. And in fact, we're going to get into that a little bit more tonight. That'll be some of the research I want to share tonight. But the Fed's going to see that they're going to drop the interest rate, and it's really the dropping of the interest rate. So that's why the yield curve is going to invert. So what ends up happening is the Fed raises the Fed funds rate, right? So it goes, they'll take it from where we were at 0 to 5 over a year and a half, right? And so they'll zoom that up, and then slowly but surely what happens is, assuming you were just to stay on that trajectory without the endogenous cycle playing out and then ultimately making kind of a disinflationary move, assuming we just kind of kept on like we have, eventually the long end of the curve, the 10, 20, 30 year will eventually meet parity as it meets and recognizes what the where the Fed wants to set the rate on the long term. Eventually it'll do that, and what will happen is, not because rates are going up, but because there's just this natural cycle that happens in the markets. Eventually you'll see a deflationary shock, bam, and then the Fed will then take the short end of the curve. I think I should be reversing my hands here, but you guys get it. They'll take the short end of the curve, the Fed funds rate, drop that to zero faster than that can transmit down the entire yield curve, and then you get the reversion of the yield curve where it's going back to normal again, right? And so that's how it usually plays out. So my point is, it's when the Fed drops the Fed's fund rate back to zero that we're likely going to see the recession. And part of that is, one, we're seeing a contraction in growth, in part because you're getting a natural slowdown of government spending heading into the end of the cycle, and then that leaves the endogenous cycle to kind of carry growth on, and so one that has its own dynamics that are at play, that are kind of. They're I don't call them autonomous, but it's just part of the cycle and the system that plays out. It's going to do its own thing, and as it reaches its end, that's going to send the signal to the Fed, to the market, that things are starting to get a little tight. The Fed drops the interest rate to zero. What they do by doing that is stop any additional interest income heading out to the private sector to kind of bolster the financial sector, right? So that gets cut off, and then you get kind of the nail in the coffin. And so that was my argument that I was trying to make on the show, and there was some pushback to that, that the rate hike thing happened, maybe even during the crash or after the crash. I'm sorry, the rate drop thing happened. And the point that I made is, one, ultimately, he was right going back prior to, say, 1980. They seem to be far more coincidental with where the recession took place. But after 1980, it very much took place right into the recessionary period. And part of this is because, the two main things is, one, we just massively expanded public debt to GDP during that time frame, and private debt to GDP really started to take off. And then also, too, the Fed just kind of changed the way they operated in the Greenspan years, and the overall dynamics post the end of Bretton Woods, and then also post deregulation of the 1970s and early 80s. The banking cycle took on a far more, we'll call it, aggressive endogenous cycle during that time frame. So a lot of my research, again, only goes back to 1980, and so that's what I was referencing, that it definitely took place before kind of the big two recessions, and then the 90 recession. Technically it took place before the COVID recession, but that in no way was a business cycle recession. So I'm not going to count the COVID recession in any way. So that was that was a point I was trying to make, and then the follow-up. So look, I mean, I've ran the math. I know I've done the dynamics. I'm pretty convinced that the MMT heterodox case here is correct. But obviously, if you have a completely different framework for how markets work, you're not going to be convinced, especially too if your mindset is that this 0% interest rate is causing the distortion, right? I mean, if that is something that is just so core to the Austrian perspective, that once you kind of disown them of that, then the other chips might fall. But until you disown them of that, until they realize that can't be the case, they're always going to see the Fed raising rates as a distortion of the price signal. And again, as I pointed out in the podcast, I think I made this point. It's a story in a system like we have, where loans create deposits. It's a story of income. That is the price signal that is going to the banking sector. It's not the interest rate. To a certain extent, they're indifferent on the interest rate relative to where the policy rate is, and the rate that they're going to charge is always going to be 3-4% above whatever that policy rate is for like a mortgage or something like that. So that is kind of the dynamic that's at play and how I see it. And again, until you really kind of do the work on the data yourself, if you're an Austrian guy, you're not going to get that. Yeah, Josh, thanks, man. That's hopefully you can come on here sometime and we can chat, and I'd be interested to see if he's evolved on that part at all. But to me, that is really the starting point where, if we were fixed to gold, I'd say he's right. I wouldn't disagree with him at this point, but we're not fixed to something like gold, and so you have to change your dynamics at play. All right, let's see. So that was kind of the big comment there. All right, we're gonna read some comments on the YouTube side of things, and I gotta crack open my window here because it's getting a little warm. I forgot to turn the fan on, so what I'm gonna do is I'm gonna do this real quick. I'm gonna keep talking. I'm right here. We'll look at the comments in just 1 second. I'll get some air flowing through the studio. All right, so we're going to look at some comments now, and I'll bring myself back up on camera, and let's do it. Some of these comments, I only flipped through the comments real quick, so we'll see how this ends up going. I know my wife said she was quite incensed by a few of the comments. No, I have pants on. I'm wearing joggers. I saw your comment, by the way, about Bob looking like my dad, and if you know what my dad looked like, you'd laugh your ass off. Because he does. It's kind of weird. All right. My dad's a lot shorter than me, too. It's kind of funny. Yeah, it's kind of weird. It's kind of weird. Ironically, I look like my mother. My mom was 6 foot tall, and I'm tall like that and stuff. But yeah, it's kind of funny. All right. Good podcast to clarify some of the MMT positions. Still, MMT doesn't bring anything new to economics, but I can see how finance people could use it. Nice. Thanks, man. Kenna Bitter. Oh, God, this is going to be embarrassing, too. You guys are going to see that I have a love affair with Halsey. My wife uses my YouTube account. That's the truth. Yeah, to a certain extent, actually, this is true. I don't actually disagree with what he's saying here. The MMTers will say that the only new thing MMT brings, I do. The Wicked soundtrack is really cool, and I love the Hamilton soundtrack as well. The only thing that MMT really changed is this idea that the Fed continuing to issue treasuries in a 0% interest rate or in a floating exchange rate scenario is that it's a reserve drain. So that's really the only thing new that MMT brought to the table. What MMT did, and it really kind of the broader heterodox movement, but MMT as it is, kind of understood by most MMTers, is is MMT just took, all these different ideas off the shelf and put them into kind of one coherent narrative from there. So yeah, I don't disagree. All right, let's see. Kurt, if government runs $1 billion deficit, the private sector has a $1 billion surplus is absurd. It's just accounting. It has nothing whatsoever to do with goods and services. People can't eat money. If there aren't goods and services, there's no point. I have no disagreement with that. I just don't think he understands what a monetary system is. From a finance standpoint, again, this is what's wild to me, right? I know these guys aren't finance guys. I know they're not investing, but I get a ton of pushback on this where it's like, oh, it's just, that's just stupid. I mean, that's fine. I'm going to show you guys a little later tonight one of the models I put together. And look, I mean, if you just like not investing smartly, that's your own business. Yeah, that's on him. All right. Imagine believing the government is necessary to make the private sector economy possible. Holy smokes. I wonder what human beings did to provide for themselves before the government was organized. Yeah. So again, in a barter economy, there's really no private sector, right? And the other thing too, okay, actually the way I would probably phrase this is that, yeah, the private sector is an arbitrary slice, right? So I don't disagree with that. I think I made that point as well. As the private sector is to a certain extent relative to the government sector, arbitrary way to distinguish between three sectors. So yeah, again, I think this is just someone who doesn't understand macroeconomics. All right, next up, correct me if I'm wrong, but it sounds like MMT does not try to explain how economies work, but to understand how government and manipulated markets work. No, no, it's both. But yeah, it actually does explain how the economy functions. Which again, this is what really blows my mind, right? Is, it's turning out obviously that I was right, that everyone else was wrong. The Austrians were wrong. We're not in recession at this point. We have a very strong economic, setup right here. Again, is it regressive? Yes, all those qualifiers, but everything that I've said is going to play out this year has played out exactly as I said. None of these called this, right? Listen, every single one of these guys that is ripping on me, I would love for you to show me your calls at the end of 2022 where you said, no, we're going to see this massive expansion take place in 2023. So if you have that, I'll take back my words. I'll eat my words here, but I know you didn't. And yet I was the only one that was doing it. So since you can't see it, it's off screen. There you go. You know what I was doing. Yeah, it does explain how things work, and I was right. And you're wrong. If your theory is wrong, ditch it. To me, it sounds like they equate the inflation of money as actual growth, which makes sense for a business owner. Yeah, again, I wish they would just realize that they're practically backdoor agreeing with me at this point, right? And they're like saying, yeah, okay, this style of comment, like, yeah, it properly explains the data, right? But the real outcome isn't, for the real, goods and services, it doesn't necessarily explain that, which is, again, I think I laid that out at the outset, right? We're talking nominal versus real. I agree the government spending doesn't necessarily create anything real that's going to create real production. And I personally want a very vibrant, robust private sector. I said this in the podcast, but that doesn't click. This was the one that my wife pointed out. Yeah, appears in the show transcript. It's once every 60 seconds or 30 seconds. So when I am having a debate in person or like a fun discussion back and forth with someone that's going to disagree with me, I really like to be as active as listener as possible. And I will tell them to kind of make them feel comfortable, just either disagreeing with me or trying to put it in their own words, how they, how they're restating kind of the MMT case or whatever it is. I want to make sure they feel comfortable and that I'm not trying to come off as abrasive. And so I do say yeah a lot. I realize now after the fact in podcast form, that's not exactly needed. He seems to think interest rates are government handouts. The higher they are, the more money bondholders are handed. You could say that this is true. Yeah. You could say that this is true. But at the same time, banks are all underwater on their bond portfolios. That's just not true. They do have hedging that they do have to take place, and they have to understand. Yeah, man, that's it. MMT is right, but that's a classic MMT is right. But most banks are not in a bad position on their bond portfolio. And certainly now that we're seeing massive increases from the interest income, it's clearly offsetting any readjustment the banks had to make and drawdowns of their bonds. Yeah, add some good comments. That'd be appreciated. All right, the endogenous money cycle of MMT is not the business cycle. Maybe I could have been a little bit more precise, but I thought most people watching understood what I was trying to get at, that they're separate cycles. So what we see, what I mean by that is, like, when you go on to CNBC or whatever, right? And you see the talking heads, what they are referencing when they see, business cycle data, employment or whatever, right? Retail spending, right? CPI, run the gamut of the data that you're going to have, right? What they're seeing is usually the derivative of the endogenous cycle. That's usually what is driving, what we perceive in data as the business cycle. You cannot find causal links in data unless you do a controlled random test. Doesn't know what he's talking about, but that's fine. We'll move along. Depending on the statistical methodology you're using, you can absolutely find causal links in data. Refresh the comments, Doug, so mine comes up. What comments aren't coming up? You know what happened? This is unfortunate. Because when I had to restart the stream real quick because it kept dropping out, on Bob's show's comment. Oh, I get what you're saying. Okay. Yeah. Thanks, Ty. Ty, thanks for the super chat. Just so you guys know, when I had to refresh my stream, it broke the hover over for the chat. So sorry about that, but thank you very much, Ty, for the super chat. I'll refresh in just a second. Let's see. I own 10 trillion in government bonds from Mordor. Imagine how lucky we are getting all these services. All right. That's obviously pointless. Government stabilizes things. They are counter-cyclical. Our rulers have a different nature. Again, he just doesn't understand macroeconomics at all. I don't get how net exports can create net financial assets. Foreigners have to swap their currency and buy dollars. To buy product, that dollar has to be spent by the government sector in the first place. I got to think through exactly what he's saying there. Give me a second. I'm gonna have to come back to that one next week to make sure I have my T accounts properly. Yeah, I know I said yeah too much. I apologize. He does not seem too bright. I do agree that when I did the stream that day, I didn't have the lumens high enough on my lighting. I've changed that since, so hopefully I come in a little bit more bright next time. I am on. So I listened to Schiff, rationally concluded Schiff was insane, but concluded Austrian economics was wrong. Instead of just seeing Schiff is not an Austrian. Ooh, pulling out the no real Scotsman argument. Yeah. Schiff didn't. I got into. As I mentioned, of course, you just didn't listen to the podcast. This is a YouTube on Doug Macro Trader. What's that? Anyway, I felt pretty. Oh yeah, this is TR. I'm sorry. This is on Bob Murphy's YouTube channel, and it was the actual video of. I get what you're saying. It was the actual video of our podcast that we did. So that guy had a whole back and forth in the replies. All right, I'll read that. Schiff is not insane. Oh my God. They do, all people people come in to defend Schiff. That's pretty funny. All right, I'll let them fight that out. All right, I'm going to refresh. I'm going to hit pause.
He hosts the YouTube.
And I'm going to see. Doug did a fine job explaining the MMT position. Thanks for having on your show, Bob. Thanks, Ty. I appreciate it. Let's see. I like camping. Yeah. All right, that's my responses to the stream. Anyway, I thought it went pretty well. Hopefully, Bob and I can chat one way or another in the new year. His call has been for recession. He's now pushed it out. Originally, it was at the end of Q1. He's now pushed it out through to the end of Q2. I'm sure, as the recession never hits, it will continue to push it out further and further. But at this point, the yield curve is starting to revert kind of across the entire curve. So it's starting to flatten once again. So according to their models, we should be close to a recession soon. Again, it's obviously when you don't need to be right with your models, right? You're just you're kind of like a false prophet, so to speak. You can just keep moving the goalpost down. So I would suspect that what will end up taking place. I mean, I do, I think in his theory, it would be once the reversion takes place is when you'll see the recession take place. So I'll give him the extra 3 months, although it does seem like a lot of time. But I don't think. Yeah, in all sincerity, I'm kind of needling him right now, but in all sincerity, I do. It's been great to talk to him. Him and I still have a little back and forth going on in the email and stuff, and I have some kind of novel thoughts myself from an MMT perspective that I've shared with him that one of these days I'll say out loud. But that was it for the podcast. I'm going to pull up something on Twitter that I want to cover real quick. And I do want to cover his back and forth that he had with Rowan Gray. So I got to find it real quick. Give me a second. He tweets a lot more than I do, so it does take some time. It does take some time to find it. So I'm going to switch over to this. I do want to bring up a couple thoughts and also kind of get your take on this as well. My thought here is, okay, so the back and forth is pretty much that obviously the MMT position is there should be some sort of student loan forgiveness. And that seems to be, kind of the status quo, the MO for all MMTers. And I talked to Bob about this because I thought I understood what he was saying when this whole conversation back and forth got off the ground. And I thought his position was, operationally, there's no difference between a $500 billion tax cut and a $500 billion loan forgiveness package, right? From the pure mechanics, the accounting mechanics, they're effectively identical when it's all said and done at the broadest macro scale. Obviously, when you narrow in on who's going to get the benefit of that, it's different. But in the implications of it might be different, right? The longer term outcome of a $500 billion tax cut or a $500 billion loan forgiveness, depending on what sector of the economy is going to get there, or what sector of the income strata is going to get that, is going to have different impact. I don't. It's distribution of spending. Thanks, Josh. So that, there is that aspect to it, but I agree with Bob that operationally it is identical. And this is the one thing that I'll kind of give Bob credit for, at least kind of pushing at, right? I don't know if this is the point he's making, but this is definitely a red flag that comes up with me kind of from like a philosophical standpoint, right? The is and the ought fallacy, right? Because just because, in this instance, it is doable, right? It is doable being the student loan forgiveness, right? And just because you're not taking any money from anybody, right? I mean, that is all true, right? But that doesn't necessarily follow that we ought to do that, right? And to me, it feels like, okay, the MMT case is always, from my perspective, is always, let's understand the monetary operations properly. We're not borrowing from China. We're not borrowing from our future children. Let's just at least understand what it is, right? That government spending adds net financial assets, capitalizes the private sector, is provisioning itself when it's spending, right? That whole story. Let's understand that. And then, right, there are potential ethical, moral obligations, implications that come from this idea that, we're going to create a society with a central government that runs the banking system, right? And part of that might be some sort of debt jubilee, right? And then you make that moral argument and say, okay, and have kind of a legal framework. Look, there were a bunch of college students from the late 90s into the through the early 2000s into the 2010s that were all sold as bill of goods, that student loans were going to be this panacea for them, and it was going to make them all sort of income, and ultimately that turned out to be false, and it was like, it was a lie, right? And so I would say, yeah, that's a pretty strong argument. People really got lied to and screwed over, and I think they deserve some justice in that case. But you could also make the counter argument, which is people also very much understood exactly what they were doing and abused student loans. Whether they used the student loan to kind of subsidize their lifestyle, paid for their living expenses, groceries and so forth, while they, continue to have a job and, just went to online college or something like that. And not that you can't have a job and a student loan, but, people certainly abuse the student loan kind of pipeline and use it just as effectively a form of income. And so the question is there a moral hazard there? And to me, that is the discussion that needs to be had. The other discussion, and I thought Ty made a really good point too, is there is some sort of limited resource when it comes to education. So, for me, it's not just we can do this, so we should. There are moral implications. There are legal implications that we need to think out. Now, at the end of the day, I think some sort of student loan forgiveness is fine. Like a lot of people got really screwed over, but I don't. There are people who wear the MMT banner who think that if you pause at all and say, hey, let's think out the student loan forgiveness, that you're some sort of serial killer or something like that, that you're just the most evil person in the world. But every monetary decision that gets made, every fiscal decision that gets made, will have a consequence, and let's just make sure that we thought through the consequence. And my position would be, I think some sort of student loan forgiveness makes sense. How we can get that done, what it's going to look like, remains to be seen. I would love to see it, and that I would also like the tax cut as well. I think we could have both of them. Certainly get rid of income taxes. So I did, tying in Bob to kind of finish off that discussion. I thought I would go there as well. What about a negative interest rate on student loans? That'd be kind of interesting. I like that. We could definitely, maybe do something like that. Smarter minds could take this over. There's just it's not something I really care about when it's all said and done, I guess. I'm not passionate about it, but I'm just saying that from my perspective, I think there needs to be a little bit more willingness from the MMT side to say, no, we need to talk about this. And I think there is. And then also, too, I get Bob's point that, and this is really it, right? I think what Bob is trying to get at is you're going to have a knee-jerk socialist reaction when I say, let's do a massive tax cut, right? But yet operationally they're almost identical. And I would agree with Bob in that sense that, you're sliding in your more moral, ethical politic in the back door through MMT. And my argument would just be don't make MMT purely your, kind of personal ethical politic, right? MMT is not forgive all loans at every time because we can. And I know I'm straw manning a little bit the argument that his side would be making, but just to summarize it in a word or two. All right, I'm going to wrap up the kind of the Bob Murphy discussion. If you made it this long, you're in for a good treat. One of the things I've been working on. Okay, one of the models that I've had for quite some time, and of course I don't even have it set here, but I'll kind of explain it to you. Well, shoot, maybe I can pull it up. Maybe I can pull it up real quick and just show you, because I think I might be on that screen. Yeah, you're gonna have to forgive me here because I don't have the background black. It's gonna just be terrible on your eyes. But one of the first models I built 2, 3, maybe even 4 years ago now, that was really kind of a dynamic model, was what I called the MMT macro Bayes model. Worked out really, really well, did what it was supposed to do, could really understand, isolate really strong bullish conditions in markets, but it's always had its weak points. And this idea converged to redo from the ground up the MMT Bayes model with this discussion I've had with a lot of people, which is like, hey, Doug, I want to get into active investing, right? Right now I'm not, but I want to get into active investing. How do I even begin that process? And it's a question I haven't had an answer for. It's not an easy question. One, because everyone's just gonna have their own risk tolerances and all that sort of stuff, and then two, just personality wise, right? I mean, it's just tough to understand how to do that. And so, yeah, I mean, some people are going to be risk averse, but they understand it's something they want to do. And my theory has always been just send it and see what happens and live with the consequences. So those two discussions have converged. And the other thing too is that I've figured out a few more things, better ways to calculate some of the things that I've tracked, some of the underlying features in these models. And so I went back to the drawing board, and I also wanted to try out a new methodology called XGBoost, which is like a decision tree nearest neighbor model. Works a lot like, especially with kind of the data that I'm using, works a lot like kind of the deep learning models. And I thought it would be a good tool to use to kind of come up with something similar to really what's kind of happening with the Bayes model to create a classifier model when it's all said and done. So that was what I was doing. And again, the essence of this, right? So the essence of, you know what, I'm just going to show it to you so it can make sense. Here's the production model when it was all said and done. And let's see. Chat, you guys still there, by the way? I haven't seen any chat. I know I'm just kind of talking on stuff, it's relatively new, so maybe you don't have anything to chat about, but just let me know you're chilling, because chat went quiet there. So here's the production model. Again, this is using the XGBoost and various kind of MMT features. But the whole concept of this is, okay, you have these underlying flows. Thanks, Chad. I appreciate it. You have these underlying flows, right? Primarily the big three are going to be your bank flows. Well, really, actually, I mean, the big two are just going to be your bank flows and the fiscal flows, right? And then how those interact with each other. And then you have kind of this Minsky dynamic as well. So to me, you're still staring at neon dots. Yeah, this will make sense in just a second. So, the idea here is how strong are the flows, right? That is really, if you were to go from kind of a buy and hold strategy to actively investing, the first step you'd want to make is, especially if you don't want to be trading a ton, you don't want to have to look at it every day, every week, maybe every week you take a peek at, kind of the models and say, okay, do I need to make any adjustments? That, the first step you want to do is say, okay, all I want to do is get out of the major drawdowns, right? Out of the drawdowns that were greater than, say, 15%, right? If I can just do that, I'm happy. I'll sit through the okay times. I'll sit through even the mediocre times, but I really want to get out of the big drawdowns, right? As it stands, the 87 drawdown, the 2002 dot-com bubble, the 2008 great financial crisis, and then 2022 drawdown, right? Can we at least stay out of the way of that, right? Is there a way to understand the flows are going against me? And so again, I'll show you then what goes into this model, but that's what this model is ultimately trying to do. And as it is, by the way, this model looks 1 year forward, looks at the return, and then determines 0 through 3 what sort of quad we're in for flow, so the highest being the best flow. And this model trains up to 1 year in the past. So it would have made the call live in January that we were going to start seeing strong flows. I do train up to the full live data, but I'll show you the testing in a minute. And this is where things get a ton of fun when I finally get to the testing of this thing. Boy, oh boy, what I've kind of pieced together here is the real deal, and I'm pretty excited for it. But let me now take a quick step back and just kind of show you the three inputs that are going into it. The first is kind of the classic fiscal flow. And this will also then to explain, how the business cycle works. And we've been over this before, but we'll give kind of a refresher, and then I'll have something cool to show you to really visualize this. But the first is going to be the fiscal flow. And generally speaking, you get below the zero line of the fiscal flow, and that is bad times for markets. Obviously, the three big sell-offs occurred: 2022, 2008, and then 2000. But the question is, we had this long drawdown that took place in 2000. Why were we able to get a rally in stocks during that time, right? We were getting pretty darn close, starting in 2005, 2006 as well. Why were we able to get a rally at that point? And it's because it's not the only cycle that's creating, effectively growth expansion for stocks. The other cycle that's taking place is this credit cycle. And as that expands, that can take over, right? So there's this endogenous cycle that expands. Now, one of the things that Minsky teaches us is that capitalism is unstable, and the instability happens on the upwards push. So it's when we're pushing upwards into the dot-com bubble, into the great financial crisis, that is actually creating the instability that is there. Right. So we got our growth during the dot-com bubble, not from the fiscal side, but from the private debt side. So here's the next question then. Well, why didn't we get a big collapse in, say, 85 heading into 87 or into the late 70s, right? Well, that has to do with the total amount of private debt, right? So now we're looking effectively at three different facets, three different vectors of the input, three different variables that are all working together in a dynamical way. In the late 80s into the dot-com bubble, we had, relative to what ultimately was our peak, which was about 170 private debt to GDP, we had a relatively low private debt to GDP ratio. So you have three things that are going on at any given moment. So I thought, what might be cool to visualize this is put this entire thing on one big plot and plot it all together in three-dimensional space, and that this can kind of maybe give us a visualization of this entire process working out, right? This kind of dynamical system at play, and maybe we can suss out. God, I knew this chart would finally get the chat going. Yeah, thanks, Eugenio. Thanks, Ty. Yeah, this was cool. This is what I had in mind, and this will all draw it back to the model that I had. So let's put all three of those together. So here's what we're going to do. Is currently on the y-axis, this is going to be the government spending on the y-axis. On the x-axis is going to be private debt to GDP. So right now, higher on the y-axis means more government spending. Further to the right, on the private to GDP axis of the x-axis is going to be private debt, and then right now the z-axis going back is going to be the bank credit. But we'll look at that. That'll be the big reveal at the end. And what I did, because it really does just kind of help identify this, is I did put this plane in the middle that shows where the zero line is on government spending, because it really is when you get to that zero line that you got to be careful. The next thing I did too is I did shift forward the returns, or technically backwards. So I'm looking forward in the return for the dot that actually gets printed. So it's looking for 18 months out. And I thought that kind of just demonstrated, that so I'm going to hover over the dot in September 1st of 2007, right? So it's saying 18 months out from now, things aren't going to be good, right? I mean, that's the idea, right? So I can go back to that idea of like, hey, how can I tell where we're at, right? If I just wanted one thing to look at and understand where we're at in this dynamical cycle kind of playing off each other, how can I tell? That's the idea. 18 months forward, 18 months from now, we're going to have the worst returns, right? So that's the general gist. So again, you notice that anytime we get below the zero line, things start to get a little dicey. Now, the reason that all this 2022 data is gray is because we haven't actually had the full returns 18-month forward at this point, right? So that's why it's gray. But when it starts to fill in, we know we dropped in 2022, so this will be relatively red when it finally gets there. But that's why at this point, because I'm shifting the data to look forward 18 months, that it is that way. So you can see the three big drawdowns all get pretty darn close from the monthly or the government spending. And then the next thing you'll see too is the severity of the sell-off gets worse the closer you get to 170. So again, private debt to GDP gets higher. You notice that that's where the danger zone is. So on heightened risk as debt to GDP pushes higher. So, even though we had a severe sell down, it wasn't a, great financial crisis level of sell down, because going back to the private debt to GDP level, we just haven't gotten back to that point yet, right? Last up though, and this is where the fun really is at, is I'm now going to twist this. So the bank credit year over year is now in full view here, and I'm going to kind of twist it just a little in 3D space so you can see, as we pushed higher in that credit cycle, it was at the peak of that credit cycle where things really started to get dicey, particularly in the great financial crisis. So it shows the three dynamics that are most important when it comes to flows and how they interact all at the same time. Now you might be asking, where are we today? Well, I'll go ahead and flip us back this way. I'll turn back on our little plane here, 3D mesh, and then I need to switch it to the orbital rotation, and we'll spin around. We're right in the back right here. So right now, in terms of government spending, we're fine. We're above the sweet spot. Obviously, private debt to GDP remains relatively stagnant. But when we look at this from kind of we'll call it the Minsky moment perspective, let's see if we can pull it back up here. There it is. You guys see it. There it is. We still have a long ways to go before we reach the Minsky moment for kind of the credit impulse. So looking at all three dimensions, I think we're good. Now the question is, can you shove this in a deep learning model of some sort, and instead of having to be like, how do I look at this stupid thing? Obviously you want the visual, you want to know that it's there. Can I shove this in a deep learning model? And that's what I showed you. That you can. You absolutely can. That's exactly what this is. Again, I used XGBoost, which is, I think, for the type of for what I was doing with this entire thing, I think it made the most amount of sense. It's tabular data. It's relatively simple. I've defined my three variables. Tug the MMT macro trader's exclusive three-dimensional phase plot. Yeah, that's exactly it, man. Yeah, that's what I'm going to call that. I'm going to steal that name, a phase plot. That sounds cool. So anyway, that's exactly what this is. Here's the fun part, guys. Here's where this gets like bananas to me. Okay. So when you build these models, you have to train and you have to test them out, right? How you test them is you have a training set, right? And then you have your test set. So it trains on the training set. It builds the function that it's ultimately going to use based on the data, and then you compare it to the outcome of your test set. Right, so it never gets to see the test data; it gets to see the training data, and then you compare and see what it turns out to be. So it got to see 80% of the data in this test. It understood and got to learn from the dot-com bubble, from the great financial crisis, and then the run-up afterwards. So you'd expect, right? I mean, if all I were to give you is this thing, but cut off the last year, right? You understood kind of what I understood. You'd say, yeah, I bet it could learn from that data. And you'd be right, it did. But then I wanted to push this model even further, right? How good could it do if I trained on only the first 60% of the data, which means I'm cutting in to a little bit. So in other words, it's testing on the 40% of the data. That's the 4 mean. So I trained on 60, tested on 4. It cuts off right in the middle of the great financial crisis. And holy cow, it kind of figured it out. It still understood the flow dynamic. I mean, it didn't do the best that it could have in the 2022 period, but it got it. It did pretty good. I'm not too upset with where it's at. So we're rolling. I can do it. Obviously, when you train a production model, you train it on all the data that it has. But again, while you're going through the testing, you want to see how does it perform. So what if I took it back 60%, right? What if it tested on 60 and only trained on 40, right? So it only got up into 2000. Again, based only on that, it still did a damn good job. I couldn't believe it. Really the only the only drawdown that it got to really play around with was the data that it had at the early 90s, and we were having a bit of a pullback there. So it clearly understood those dynamics, and then went 80%, and it still had the gist. I mean, it just played an ad. Oh, missed 20 seconds. That sucks so bad. God, I am so sorry, guys. I have to remember it. It's like forcing me to keep the ads out when I go live, and I need to remember to turn them off midstream. So I apologize about that. Let me go ahead and let me just try and do that right now. But anyway, all the way back at 80%, it still has the gist of what's going on. Obviously, there are some times in 95 it gets it completely wrong. And like the worst part of the great financial crisis, things were doing okay. But again, it only trained on the data up until about 1994. And I thought we were going to do okay in the second half of 2022. Obviously we didn't. So yeah, so be it. But still, it has the gist of it, even with a very little amount of data. So that is the model that got put together, and this is now going to replace the Bayes model that we have, and again will be available on the Patreon page once I need a little bit more testing, but that's the general gist. So. Look, man, I'm pumped to get this thing in production. It's something I've wanted for quite some time, and then soon I'm going to have Ryan from Applied MMT Trader or Applied MMT the podcast come on. We're going to kind of discuss a little bit. He's what is called a Bogglehead. He's going to call, if you're familiar, it's kind of a buy and hold strategy, and we're going to talk, which I think is the right approach. If you want to get into investing, that's like the first approach you should be. And we're going to discuss, how, what are some of those theories? What's the underlying theory that drives that? And how can we kind of move that into a more active investing approach? And I think this is the right way to do it. I think this would be kind of the first right way to do it, is to use a model like this and say, okay, I'm willing to be fully invested in green, but then maybe hedge when you get to red or yellow or something, something like that. Jack Bogle. Yep. So that is the model that has been pieced together, and one of the things that I wanted to unroll once I have it all prettied up and it's everything I want it to be. I'll make a little standalone YouTube video going over all the highs and the lows of it, but. That is the new, Bayes model. So this is going to be, maybe I'll call it like the phase flow model or something cool like that. That's a good idea. I'm gonna actually write that down real quick. But anyway, that's what I wanted to share tonight, and I kind of like it. So phase flow model. Yeah, we might go with that. It's kind of what I have on the docket for tonight. I have a few other thoughts as well. I have what else did I want to show? Did I want to hit up anything else on the one other thing I did want to point out. I'm sorry, I'm going to switch back to this screen right here. One final thing that I did want to point out is, I think this is kind of where the head fake is for kind of some of the heterodox type is I think what never played out over the last 15 years now and maybe to a certain extent did in 2022, but just not enough. As I don't think we saw enough of an acceleration to the upside on the bank credit side. I think that's just, we never had a Minsky. I mean, obviously we never had a Minsky moment, but we never had we'll call it a Minsky inflection, if you will. So that was kind of the one thing that I think there was a lot of head fake, because now that we're seeing the big drawdown on the bank credit side, I think so many people associate that with, kind of into the world, but it hasn't been, because we never had the inflection point from the Minsky side of things. So that was kind of one observation that I wanted to finish off on for today. That's the high notes for kind of the new model. And like I said, I'll get a standalone video out soon. It kind of covers all of that. And and then we'll have Adam on, and we can kind of go back and forth. And the whole idea of having Adam on is, we'll do some prep ahead of time. But I want him to ask me questions in real time, and you guys can kind of hear the conversation, because I know that is, really, that's the question for people who aren't actively trading. How do I move to the active side of things? And I don't, I want you to be well informed if you're going to make the push, that direction. The last thing I had for tonight, at least kind of on the docket, if you guys have any questions you want me to cover, was just to go over kind of one of the tweets that I had out this week. And it was just kind of the book Trillions is solid history on Vanguard. Actually, I'll reserve. I think there is there's some risk with the Bogglehead approach, long-term risk, but we can discuss that when we get there. I'm going to end on this tonight. Actually, no, I will end on that. But before I get there, we are going to see the CPI come out tomorrow, so that's going to be kind of cool. Just wanted to give you guys heads up. I guess got to talk markets real quick. Obviously, we had the bounce from last week, one of the things we were anticipating, but CPI could dislodge things a little tomorrow, so that'll be fun to watch how that plays out. At this point, I still haven't got the signal to go all the way. I did start opening up those positions at the end of last week, but I am looking to maximize soon, because I really think that the run up heading into the end of the year is going to be pretty strong. But we still could have a little volatility until then, and that could tomorrow's CPI data could spark that. Let's see. Gonna finish off. This sort of stuff just you want to know what really grinds my gears, really boggles the mind. Paper money turns government from parasite into predator, aside from stealing your life savings. I never understood this, why these people are so stupid. I don't. One, in terms of money printing, the U.S. has printed more than any developed nation. I think at least Europe, and had the most spectacular growth in any other nation since the Great Financial Crisis. I'm going to pull this data. It's too much of a distraction right now, but I'll get to it. Remind me if it's something you really want to see done in a week or two, and tell me, Doug, you got to get on this right now. But the U.S. has what I want to see is relative to I think there's the called the Paris nations, 22 or 23 nations that are the top nations in terms of developed nations, and I think I might use that as a list. And I think out of that group, the U.S. is without a doubt printed the most amount of money since the Great Financial Crisis. And, by me, I would count, printing money as government spending, right? So government spending, and then, so it would be outstanding reserves plus treasuries that are out there in the banking sector, and the treasuries held by the public or not held by the Federal Reserve, and currency in circulation. That's what I would call money printing, right? And so if that's the case, the U.S. is without a doubt the worst in that. And in every measure, we've outpaced the U.S. has outpaced the rest of the world in growth, not only from a stock market standpoint, but also just in GDP over the last 15 years. So your best bet was to invest your money in the country that was printing the most amount of money. So, just on its face, it is absurd that it's stealing your life savings. Two, it paid to go with the country that was printing the most amount of money, right? And the fact that they don't even think past step one. This is what bothers me so much is they don't even like the advice that they're giving. Right? I mean, I'm not giving straight advice, but certainly what is being implied here is that your life savings are going to get stolen by the U.S. One, just don't put it in cash. But if you did, you're actually kind of okay, right? I mean, relative to say putting it in any other currency over the last 20 years, 15 years, you're fine having put it in the dollar if you're just going to keep it in some currency, despite the dollar being the most printed currency by trillions in the world over that amount of time. Still, you're okay. But just invest it. I mean, just invest it. And then there's one person too, he never responded back saying, oh, what about the little old lady? I mean, why are old people necessarily bad investors? Why are women necessarily bad investors? Do you think they're not savvy? Just because your dumb fucking ass can't figure out how to invest doesn't mean that the little old lady can't understand to, buy some fixed income instruments and a couple stocks. Jesus. I'm sorry. Got a little heated there. Like, I'm gonna digress, but you get the point. This got me going. Maybe that'll be a weekly part of the show. What really grinds my gears, and this really grinded my gears because these guys somehow get a PhD and don't understand the first thing about finance. I mean, they are amazingly dim-witted when it comes to finance, and in one sense, fine. I mean, I'm thankful for it in one sense because this guy is just handing me money hand over fist in markets if he's investing in gold or whatever. Well, maybe not directly, but you get what I'm saying. I mean, these guys these guys are the reasons that I'm the winner when it comes to it. But I mean, you see this 2 million views. In actual reality, because the way the count works, Elmo is inflating this by the equivalency of probably about 1.9 million. But still, you get it. I mean, this stuff is just swallowed up by so many people, and it is just. I mean, if they had at least 5 or 6 brain cells jumping around in their head, they might piece together how dumb this is, but they can't. So it is what it is. That is really what I have for tonight. I'm going to kind of read through comments here. Investing needs to return to those who wish to support innovation. 100% TR. 100%. I agree. I agree. I would take kind of investing much more into a venture capital style approach. Certainly get banking out of the investing world, and I would be fine with that. It would completely undermine everything I'm doing here from an MMT, applied MMT approach. But also, it's not a terrible risk of it happening anytime soon either. So I think we're safe there for what I'm trying to do here. Let's see. Investing success is inversely related to the number of likes and views. Yeah, apparently that seems to be the case. But we're going to grow that. Adam and Ryan over at Applied MMT and I are chatting, and we're gonna try and make a big push here to really kind of get the Applied MMT message out and about. Doug, have you seen a rise in the tax take with interest rates adding income to the economy? You'd expect to start to see it feeding into more tax returns. No. Not necessarily. When it will start to really feed in is when that kind of capitalization of the banking sector really takes hold, and we see growth coming from the endogenous expansion. That's when the tax side is really, really going to take off. There's been reasonable increase in taxes, but it hasn't really taken off. So I think your point is eventually you're going to start to see the tax drain increase to offset the government spending, and that will take place at some point. At this point, it hasn't taken off enough to really kill kind of the long-term trend of deficit spending. So when we look at this chart, that that is eventually what crushes deficit spending over time, is the fact that the government does business cycle starts up again, and the government does just start spending less and less net because it's taking in more and more taxes. So that's going to start soon, if not already starting to inch ahead, but it doesn't necessarily have to be that way. That tends to be more of a function of the private debt side. Good question. All right. I guess we're going to call it short tonight. I think I said everything I needed to say for for this week. And like I said, I'll have the 3D model in a standalone video. I thought it was pretty novel. And again, this is a model that will be added to the added to the Patreon soon, and is kind of a usable model. But if you're looking forward to this, it might take a few more weeks before I say I'm ready to go live. I want to do a little more testing, make sure it is what I want it to be. But it will be going live very soon. I also need to understand a little bit better what the XGBoost is exactly doing. I've had a lot of extensive testing with deep learning models. And so I have a pretty good sense of what they're actually doing. And maybe I'll run kind of my core deep learning model against this, but and see what performs better. But my understanding is what I attempted to do with the Bayes model originally made as much sense to do with something like XGBoost, and it's going to pull it off a lot better. And will kind of show us where we want to go going forward from kind of understanding a flow standpoint. So that's what I got. I got one more comment here. When it is understood each working person pension may equal the wage of the average high 3 years earnings, then retired people will have money to invest with the tools of that's it, right? You held on the fort without the co-pilot. We had a soft landing. We did. We had a soft landing. Hopefully Bijou will be back next week. We'll keep it rolling from there. All right, guys. I think we did it. We'll wrap it up here. Thanks all for tuning in. And normally Bijou has those cool outros, and I'm not that good, man. I'm just not that good. I can't even try an outro. I mean, I can do the cool radio voice, but that is to the extent of. Oh no, you don't want to hear me sing. All right, that's going to be the extent of the outro. Thanks everyone for tuning in. I am going to wrap it up here. So until next week, good trading everyone, and we'll talk to you then. Bye-bye.